Since the days of grain merchants acting like banks through to today's global banks, centralised organisations have evolved to allow us to trade and transact in a trusted manner. But when financial markets crashed in 2008, giving rise to a global credit crunch, something changed. While bankers emptied out their desks, a pseudonymous individual or group known as Satoshi Nakamoto was busy publishing a short document which would go on to change the world. The white paper, entitled Bitcoin, a peer-to-peer electronic cash system, described a means of transacting that would do away with the need for banks and middlemen. With this new form of digital currency, or cryptocurrency, anyone, anywhere, could now exchange money in a decentralised way, peer-to-peer. The birth of Bitcoin was revolutionary on two fronts, giving rise to the birth of thousands of cryptocurrencies, all with different features and benefits, and sparking waves of innovation in the infrastructure of finance. The infrastructure underlying cryptocurrency networks and the exchanging of bitcoins, blockchain, and distributed ledgers could be used as a new trust layer for the internet. Technologists began building enterprise applications not just in banking and finance, but also in supply chains, energy markets, healthcare, and other sectors. In finance, the range of applications became more and more wide-ranging as the idea of tokenization of real-world assets took hold. From non-fungible tokens to decentralized finance, or DeFi, suddenly a whole notion of what constitutes banking and finance was being turned on its head. New ideas, companies, business models, and investment opportunities abounded. Although the origins of cryptocurrency were rooted in creating a form of money which would work outside the traditional banking system, something else happened too. The incumbents in traditional finance saw the potential benefits of digital assets and blockchain and gradually began to embrace these technologies. And the innovators realized that the institutional markets presented them with a huge opportunity to digitalize and modernize the centralized, creaky legacy systems of the past. From these two directions, we are witnessing an era of convergence. Banks entering the Metaverse, traditional players opening digital asset arms, employees from the likes of Goldman Sachs jumped ship to the new players in the digital asset world, while banks began hiring blockchain and cryptocurrency specialists. So what does the future of finance hold? Could DeFi eventually become the new infrastructure underpinning the financial markets? Will cryptocurrencies coexist and interoperate with central bank digital money rather than replacing it? Will we all be banking in the Metaverse in a new Web3 world? In this documentary, we speak to leading experts across both traditional and decentralized finance to understand more about how the era of convergence evolved, what is happening now, and perhaps, most importantly, where the future of finance will take us.
It's now been over a decade since the Black Swan event, but what has been the real impact of Bitcoin on financial markets? And did it pan out in the way its original supporters expected?
When you look at what Bitcoin is, it's really just an elegant technological solution that later had all these profound political, social, economic implications that really changed society.
None of the other ones had worked, so Bitcoin was really the first attempt at creating a digital currency that didn't rely on the traditional banking infrastructure.
Bitcoin is really the trendsetter. Those of us in crypto can call it a gateway drug. And look, it's the one that people have heard of. So I've been crypto sort of 4.5, 5 years now. And I used to text people in the industry if crypto was in the mainstream press because we were excited. And now we don't bother because it's there pretty much daily. And it's not just Bitcoin anymore. People are talking about, a selection of cryptos, the altcoins, talking about tokenization. They're talking about custody issues, regulatory issues. So Bitcoin is kind of the thing that people have heard of, and particularly look at what the regulator in the UK says. Definitely sort of the trailblazer and the trendsetter.
But the point about Bitcoin is it's the first implementation of blockchain at scale. It's the first time that we've been able to see essentially a system that allows people in a trusted and transparent way to exchange value without intermediaries.
When you think about Bitcoin, for me, it kind of went through three different waves. So the first was, say, 2008-9, when it first hit the scene. Back then, it was a beautiful utopian idea of allowing people to transact business, but with no middlemen between them. And that appealed to the sort of, free society thinkers, anti-government folks. Obviously, what happened is because that meant you were free from government oversight, the first people transacting in Bitcoin tended to be money launderers or people selling things that perhaps really they shouldn't. The second phase was when the big banks looked at the underlying technologies of blockchain and DLT and said, can we use this to solve all the hopeless inefficiencies that we have in our post-trade transaction processing businesses? And despite the billions invested, they soon discovered, maybe it took them a bit longer, but they discovered that until everyone was on the same system and the same flavor of DLT, you were just adding to the problem because it was yet another standard that had to be reconciled with everything else. And then the third wave, which I think is the most interesting, is Bitcoin as a investable asset, as a store of value. And that is kind of fairly counterintuitive because Bitcoin was always supposed to be a means to exchange value, not a store of value. But the question comes down to, is Bitcoin something that is an investable asset? And that comes down to belief. Do you believe that if I hold Bitcoin, I can sell it and get TradFi money that I can use to go and buy something else with?
Now, what's interesting with Bitcoin is that it's basically what I like to call the Solomon of asset classes, because it swims against the current in the sense that it was created and it's born by the retail investors, from the retail investors, and it's making now its way up the current to the institutional world. To me, that is the perfect example of how these two worlds are colliding on conversion today.
You have the community, if you like, of blockchain believers who have been transacting and using blockchain and Bitcoin and all of the different digital assets that are available, and they operate kind of independently of the financial system. I think the second group to look at is in emerging economies, and the growth of digital assets in emerging economies is more rapid than the growth in other economies, and the proportion of the population that own digital assets is higher as a proportion of the adult population. So if you look at the top 10 countries with people who own digital assets, then you're looking at Nigeria and Latin America and countries in Asia. So people have found real utility because their currencies don't work and their financial systems don't work.
I think anyone that's in an incumbent environment that understands technology, the nature of identity, security, data provenance, got interested in blockchain early because they could see ultimately as an infrastructural tool, boy, it made a lot of sense. Better sense maybe than the infrastructure that we built what we call Web 2 on.
Bitcoin sparked a whole new wave of innovation, including the development of a new financial markets infrastructure built on blockchain and the birth of a whole new set of asset classes in crypto and digital assets. But what happened once this new wave of innovation started to flourish?
So different types of digital assets will transform trading and investing through a reduction in risk and a reduction in cost. And that will come about from using blockchain to have more immediate settlement that will be cheaper. And the more immediate you settle things, the less risk there is across the market.
A big play there to make sure that the markets are safe. You know, we had the crash in 2008. We want to have now proper transparency in the marketplace. And they want to make sure, just like traditional finance, that people understand that. And we're not going into a situation where people are trading these products and no one knows what's going on. And, you know, or one and pop puts some money behind, then it just disappears.
Well, the key thing here is efficiency. If you look at traditional financial markets today, although the sort of actual trading activity is electronic and fast and super efficient, what happens post-trade is massively inefficient, with lots of intermediaries involved, lots of cross-checking, reconciliations. You know, it is an inefficient, expensive nightmare, basically. The blockchain technology streamlines all that.
But it hasn't solved every problem. So what Bitcoin has done is launched a load of other digital currencies, some of which enable people to send money instantly or send money, you know, for free, and that have perfected more of the light transactions and the ability to send micro transactions. And that all started from Bitcoin achieving what it has.
The truism that lots of these things start out looking like toys and then they become established use cases. NFTs, I think, are a great example. They look like toys and they are toys. Say they're membership tokens to a social club. You're part of a club. I think the crypto people have questions to answer about hierarchies and aristocracies. Crypto is supposed to be a really flat world, and now with these certain types of prestigious NFTs, we've got a kind of crypto aristocracy breaking out.
The focus isn't just on Bitcoin, but you've got thousands of other digital currencies, of which 99% will collapse and die, but some of them have achieved much more ability to send microtransactions, which have their own use cases, micropayments or paying for things on a per use basis or sending microtransactions or microloans or microinsurance, for example. So there's a lot more real world use cases with that.
As we talked today, there's about 21,000 separate cryptos. That is a bewildering amount of choice. You've got crypto for payments or NFTs or gambling.
In gaming, it'll be used in financial transactions. It'll be used in the Metaverse. It'll be used in a lot of the simple things we do, and everything from tickets and airlines and video games and sporting events.
There's a huge variety out there. So you'll actually see a lot of consolidation in that marketplace in the medium term. And of course, lots of chat about particularly Web3, how those blockchains talk to each other. It's called interoperability.
And we also think about automation, so putting the life cycle of an asset into the smart contract so that all of the processes across finance, which are currently done very manually, will be in an automated fashion.
Traditional markets are being transformed before our very eyes. If you think back to what headlines we've seen really in the last year plus, you've seen major market participants, household names, firms that have been around for hundreds of years entering into the space. Cowen and Cowen Digital really the first to come into the play with launching their trading business about a year ago, partnering with us for custody. Most recently as yesterday, BNY Mellon following suit. These are established players. These are institutions who have a lot of confidence, a lot of name recognition. Entering into the digital asset ecosystem, I think is really, really exciting.
When you think about the world of finance, it does affect us all, sometimes indirectly. There's a gentleman who's now the chairman of the SEC, the Securities and Exchange Commission in the US, Gary Gensler, is a former Goldman partner, and he wrote a very useful article while he was up at MIT a couple of years back on the impact of all this new technology. And he said, look, it behoves us to look at this because in the US, their best estimate is that finance is 7.5% of GDP and payments somewhere between 0.5% and 1%. So if we can make some improvements in the processes, fantastic, because in the end, we all benefit. And I think we will see new means of payments emerge, or new ways that payments get made, new ways that we custody assets that enable us to do things better.
Initially highly sceptical of one another, incumbents in traditional financial markets are now starting to see the potential benefits of blockchain and digital assets and are gradually beginning to embrace these technologies. As these two worlds collide, are we now witnessing an era of convergence between traditional and decentralized finance?
Traditional firms, they're getting players from the old traditional finance firms to come and work for them. So you've got really seasoned people alongside the new young techie guys building out the industry. So I think those two creates a fantastic dynamic for them to get into the space of being regulated.
I'd break that down into the buy side and the sell sides. On the buy side, there's certainly a lot of exciting activity because the likes of Invesco have custodied, let's say, crypto assets like Bitcoin, Zodia, which is owned by Standard Chartered with a stake from Northern Trust, and they've then put a traditional wrapper around those and listed them on traditional exchanges, which is very, very interesting because you can be off-chain and have access to those asset classes. And indeed, a large number of participants want to get into digital assets, but don't necessarily want to touch the blockchain per se. At the same time, you've got other players on the sell side that have made some very interesting announcements recently, Citi being one of them, who announced 100 hires into digital assets. Have also announced that they're exploring custodial services on the security services side. So it's a very, very interesting environment at the moment. Everyone's trying to position themselves, but at the same time, trying to figure out what they do within this environment and what lends itself to the greatest revenue opportunities.
My view is that the diversification into TradFi, particularly trading, is driven by three key factors. One is a clear need to de-risk the dependency on crypto revenues, which still show significant volatility and regulatory risk factors. It makes sense to balance the portfolio to survive the so-called crypto winters and to acquire a new customer base and an incumbent skill set from a traditional firm at the same time. Two, I would say a clear need to be able to demonstrate a capability in handling well-regulated traditional assets in order to act as a trusted and capable digitizer of those traditional assets in the future. And three, I would say more psychologically, an ambition to take their seat alongside the traditional powerhouses and escape the hubris of crypto, a keen desire to be taken seriously by serious people.
You've got a deregulated world and all the banks are highly regulated. So in order to move into that market, it becomes very, very complex for them to be able to do all the compliance, all the various levels of capital that need to be held. And so I think we're going to find that that move is going to be a big shift, and it may lose some of the decentralized benefits that they've been having and also increase their cost base substantially.
The reason why TPI Cap have moved into digital assets is firstly, we think the crypto asset class is a new investment asset class that our clients, which are large financial intermediaries, would be interested in accessing. And second, we believe the technology behind it, blockchain, is going to have use across our traditional asset classes as well.
It's very much about both sides understanding that they've got the same common goals, and those common goals being making markets faster, making them cheaper, making them more efficient, and also making them more secure.
TradFi, I think, is a cute way of saying old school, but CeFi and DeFi are, I think, very different things. DeFi implies completely decentralized, but there's no centralized body typically. There might be individuals and a coalition of people that care about the platform, but there's not a balance sheet or a regulated entity necessarily to control it. It's code. And code and finance are doing kind of great things, but the CeFi players essentially are operating like TradFi, so they have that centralized component, but they're operating as crypto native players. I think Coinbase, for example, could be one of those, which is a crypto native house that has come and grown up more into an almost regulated player. As the era of convergence, as we're kind of calling it, happens, I would hope CeFi represents quite a strong push, but it also needs to show that it can play on a level playing field with TradFi actors, because otherwise it's going to present future risks to the system.
So what role does talent play in all of this? Recently at Harrington Starr, we've seen a growing trend of DeFi companies looking to attract traditional talent and traditional companies looking more at DeFi talent at the same time.
We've all seen those jokes about, entry-level graduate job, 10 years experience required. Well, that doesn't work for crypto because we're only 4.5, 5 years old. So it's a really small talent pool. That talent pool is really in demand. And there's lots of people like myself that work in crypto that are not only really passionate about the industry, they're very mission orientated, so it's often quite hard to convince people to move. So relatively small talent pool, and actually a huge number of people that know about it. So we've seen a mass exodus from traditional financial institutions, whether they're banks or hedge funds, moving from those traditional finance places sort of into alternative crypto-related businesses.
The talent's very much evolving in the TradFi space as well as the DeFi space. We're seeing a lot of our former peers leave TradFi and move to the digital asset space in DeFi, and we're seeing the newcomers coming into the TradFi space having a completely different skill set.
Access to talent is a definite obstacle that can slow innovation in the sector. So what can be done about it? Does that mean investing more in education? Does that mean looking at different talent pools? Does that mean training and cross-training people from different industries? There's a multitude of opportunity.
It's not just about creating courses and providing that knowledge and skill set to the students. It's about creating the awareness of the industry. What do you mean by fintech? And there's clearly concern from a student thinking, well, that may be a lot about technology and I'm not a technology expert, or is it purely finance and I'm interested in technology? So creating that awareness was really important.
It's quite a small pool of talent. The good news is that those businesses are hungry for really, really talented people. Typically, they are quite aggressive startups. For people that are trying to get into crypto, whilst it's a small talent pool, often if experience is required, it's quite hard to come by. So just really being able to show that you've got that passion and that you're genuinely interested in some of those incoming trends. Crypto can be a slightly weird place to work. And look, it's an acquired taste, right? This sort of really aggressive scale-up startup culture. I always say that you start off as disorganized chaos and you're really pleased when you get into organized chaos. And actually when you get profitable, it's just a dream. But I think people that want to work in it just to be really hungry to learn, because look, it's a new industry and it's changing at a rate of knots. We often say in crypto that like dog years, sort of, a month in crypto, we probably change as much as a year in a traditional industry. So really a phenomenal pace of change for those people that are looking to work in it.
We have heard for years and years that, we've got a business graduate, but they don't know much about technology. And we've got this brilliant coder or a programmer, but I can't put them in front of my client because they don't have those business skills. And that's what the Royal Dock School of Business and Law here at University of East London is about, is how do we create courses that converge the skill set. So they have the technical capabilities, but at the same time, they have those human skills or soft skills that they need to be able to understand the business process. From a university perspective, this is a golden opportunity for us to be at the forefront of creating graduates who have those skill sets.
So what are the obstacles holding us back? Could DeFi eventually become new infrastructure underpinning the financial markets? Will we all be banking in the Metaverse in a new Web3 world? And as we move beyond the era of convergence into a new paradigm, what does the future of finance hold in store for us?
The future is really already here in respect of centralized digital transactions. Anyone who's visited mainland China, for example, will witness what it looks like from a day-to-day basis, where literally all personal transactions are via payment applications. This evidence provides perhaps a hint to the type and nature of digital currency that you are going to be spending in the future.
This is a massive technology change that we're literally at the dawn of that transformation that nobody knows what's going to lead, to be honest with you. An observer would look at the market structure or the infrastructure for markets, and an obvious point of change or obvious point of immediate disruption would be maybe that of the clearing. So traditional CCPs, traditional clearing house, would eventually see the adoption of smart contracts, which would speed up that time and would eventually remove the risk altogether for traditional instruments.
Yeah, every time you see this new idea that's being built, that's being tested within weeks, days, weeks, months, because you can connect directly to a test network, directly to the actual production networks. It's amazing. And you know that you're only seeing a tiny slither of it.
I think at its heart, what we have to remember is that finance is always going to serve and do the things that it's always done, which is allow firms to raise money and capital to be invested in different places and allow for the exchange of risk across different asset classes, as well as help facilitate the flow of things like utilities, commodities and energy. That is never going to change because these are things that the world needs. What will change is the way that we do that, and finance is never in stasis, it's always evolving, and you have these periods where there are new breakthrough technologies which lead to a huge change in the way things are done.
Banks will continue to adapt. I think they've been adapting anyway very, very rapidly with the new digital assets and digital currencies coming along. They will change. Will that fundamentally change the way we bank?
Well, the challenge for banks is, if that's better than the old technology, shouldn't you be using it? And that's the stage that I think we're at now. So part of the convergence as we look at what is it that makes this the era of convergence. Certainly the traditional financial institutions haven't converged yet to say blockchain is going to change everything, we're going to put all of our systems onto it. But it's done enough, I think, for them to say, we need to look into this because it may be that there is a better technology.
And I think what will be really interesting going forwards with this TradFi, DeFi conversation is looking at the other geographies that are that are in existence where DeFi allows that opportunity for financial inclusion. And, and we're at a world now which is very global, very connected, and it's very easy to be connected. DeFi makes those things so much more accessible.
I think the success of DeFi will really hinge on the key factor that is actually digital identity. I can't see regulators and governments accepting anonymity in digital asset transactions and then solving the identity issue without compromising and introducing new risks for the individual is a very difficult nut to crack. Given the sensitive, multi-jurisdictional, social and security implications in the absence of a central authority is very challenging.
We do see in the young a very different understanding. Perhaps that's because of lockdown and where they've grown up with technology always present around them. A different understanding of how engagement and communication works. And I think gaming is very interesting as people kind of live in the gaming space often. There's a whole ecosystem of friendships and transactions that are completely apart from the traditional payment rails, for example. The perspective of a firm like us, I think Metaverse is really interesting, but we need to make sure that if we are to engage, it's in a way that's intuitive and fits what the client base is looking for.
For me, the idea that we're all sitting with our VR goggles in the metaverse, maybe that's for my kids or my grandkids or something, but I don't think that's a near-term proposition. But I think what you're going to see is governments and larger financial institutions harness the technical efficiencies from the crypto world so that you're going to get some kind of central governance, control, believability, but the efficiency and tradability that the crypto world brings. And if that happens, the net result is a simpler financial ecosystem. And if it's simpler, it'll be cheaper and more efficient. And if it's simpler, it'll be safer because it'll be easier to regulate.
Moving beyond the hype and excitement, now everyone's very excited about being in the metaverse and thinking about, can they serve their customers better in a metaverse environment? And the answer to that, I think, is going to be, it depends.
If we take Citibank's estimates that the size of the metaverse economy in total may be of the order of $8 to $12 trillion, that's a huge size of an economy, and it was only likely to be reach that kind of scale if there is an effective monetary system beneath it. Now, whether that will be crypto assets or whether it will be CBDC, going back to my earlier comment, or other forms of money that are provided, private or public, I think remains to be seen. So if you take that kind of example, the kind of size of an economy, then obviously banks have a major opportunity in that kind of context.
So there's a strong argument that says if you are going to replace something that is decentralized is a potentially good model. And probably by the time we put this one out on air, everyone will be shouting, but what about those Australians down with the stock exchange? They just canned their $250 million project. To which I'd have to say, not quite sure what they did wrong and why they stopped it. But rather like the collapse of FTX, we shouldn't let one project and perhaps its demise be the benchmark by which we judge everything else.
One thing's for sure, things are going to change, and all participating parties and the agents of change stand to benefit a great deal.
So this is the era of convergence, the merger of traditional and decentralized finance. We're at a time of unrivaled volatility, and at the time of filming, FTX has turned the industry on its head. What's needed is trust and transparency, and this is where traditional finance can really make a difference. Digital assets have an exciting future, but change is needed. The financial markets themselves are ripe for innovation. Could the era of convergence be the change we need to see in this evolving new world?